Today, reversals ahead, the DFA daily to the 9th of July 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In today's show, we look at the market reversals overnight as longer-term bond rates fall, and also the RBA's dangerous game, plus problems in the rental markets and the lockdown, slowdown, fallout. First, this from Richard Holden in The Conversation today. There's an idea in economics that policymakers need at least one tool for each target at which they're aiming. Fewer tools than targets will mean not achieving all goals. This is known as the Tinbergen rule, named for the famous Dutch economist Jan Tinbergen, who shared the first Nobel Prize of Economics back in 1969. It has particular resonance when considering the plight of Philip Lowe, Governor of the Reserve Bank of Australia. Lowe and the RBA are implicitly or explicitly responsible for an array of economic policy targets. I can count at least 5, he said: inflation, unemployment, GDP growth, residential property prices, and the global value of the Australian dollar. Some of these targets overlap, such as unemployment and GDP growth. Some are instrumental in serving the others, such as the level of the dollar, and some are self-imposed, such as residential property prices. But it's clear all of these things factor into RBA thinking about monetary policy. Historically, the RBA has only had one available policy tool, short-term interest rates, the cash rate, to deal with all these policy targets. That makes the central bank governor's job hard and frustrating at times. For example, before the Frydenberg pivot at this year's budget, Lowe had been pleading with and pushing the federal government to use fiscal policy more aggressively, that is, by spending more on important areas. This led to tensions between the central bank and the government, significant enough to warrant a kind of summit in May 2019 to project an idea of cooperation, even if it did have the feeling of a North Korean hostage video. It's not just what they do, but what they say, which is important. Central banks have gained another policy tool with the advent of so-called quantitative easing, whereby they can influence longer-term interest rates through buying longer-dated bonds. And it's also been long anticipated that what central bankers say is also important. Their statements inform the public and move markets, so credibly conveying information provides another policy instrument. But there's a wrinkle here. It's hard for central bankers to communicate what they know credibly. Why? Well, suppose a central banker says something that is both credible and precise. Markets will believe it and know what it means for future policies. But this very fact gives a central banker reason to lie, to move markets in ways consistent with its goals. Identifying this time consistency problem helped Finn Kineland and Edwin Prescott win the 2004 Nobel Prize for Economics. The tension often leads to central bankers being almost comically vague. Alan Greenspan, the US Federal Reserve Chair from 1987 to 2006, made this into an art. But in fact, in the past year, Lowe has tried to be anything but vague. In a number of statements, he said clearly the RBA won't raise the cash rate until 2024. Why has he done this? Because he wants to affect inflation expectations and hence actual inflation. Keeping rates low increases the likelihood of inflation. If folks think higher inflation is coming, that will affect how they act now. It could lead, for example, to demands for higher wage rises, which in turn would lead to higher inflation. So Lowe is trying to create a self-fulfilling prophecy. He wants higher inflation in line with the bank's target range of 2 to 3%. Imagine there are two equilibria, one where everybody thinks inflation will be 1%, act like it, and inflation turns out to be about 1%. Another where everyone thinks inflation will be about 2.5%, act like it, and it turns out to be so. What Lowe is doing is known as forward guidance, telling the market what he plans to do for the next few years in order to shift from the lower equilibrium to the higher one. In one sense, it's pretty clever. In another, it's pretty dangerous. For one thing, it could lead to inflation higher than the bank's target. This happened all too often in the 1970s and 1980s, but perhaps the greatest danger facing Lowe is that by telling markets definitively what he plans to do until 2024, he risks the RBA not adapting to changing circumstances or undermining his credibility. We saw that tension at play this week in the aftermath of the RBA's Tuesday board meeting. The direct outcome of the meeting itself was uneventful. The cash rate remained unchanged, and the RBA's bond buying program was ever so slightly wound back. But then Lowe took the highly unusual step of holding a press conference, and he was a lot less definitive, noting the economy's recovery had widened the range of plausible scenarios for the cash rate. This means that probabilities have shifted, and the decision to adjust the approach to the yield target reflects this shift in probabilities. This underlines the difficulty with forward guidance. Can a central bank really tie themselves to the mast and set the tiller on a fixed course? As famous US baseball manager Casey Stengel once said, "I always heard it couldn't be done, but sometimes it don't always work." Well, is that clear enough? Australia's most difficult rental markets have been identified, with areas of Brisbane, Perth and Adelaide posting vacancy rates as low as 0.01%. Regional areas have long suffered from critically low vacancy rates as tree changers move out from capital cities and investors hoover up properties to use as holiday rentals rather than long-term tenancies. The government acknowledges that the ideal vacancy rate is around 3% when supply and demand are largely in balance. It is lower than that everywhere in Australia except in Sydney and Melbourne, where the dearth of international students has driven it over that benchmark. Over the past couple of years, with the restricted lending, we've seen a lot of investors driven out of the market, said Daniel Walsh, buyer's agent and director of Your Property, Your Wealth. There's not been as many investors over the past 3 to 4 years because of the lending criteria that they had to hit. Because of that, we've seen less investors buy property, and now we're starting to see a shortage in the rental market. It's coming home to roost. That's where we are at the moment, and a lot of that is driven by the fringe areas of capital cities. With COVID, people are looking towards lifestyle. They're jumping out of the units where they were closer to their work hub, and now they can work from home. They're choosing lifestyle, which means fringe or even regional areas to rent, and they're choosing more houses over units. This is almost the tree changer effect, but instead of moving out of the city completely, people are moving to the periphery. Essentially, they're saying that instead of living in a 2-bedroom unit, let's go a bit further out and choose a house with a better lifestyle for the family, said Walsh. We're also seeing a lot of interstate migration towards places like Brisbane, which is taking effect. But nationally, what we're seeing is the fringes of each capital city vacancy rates drop dramatically as people choose houses and lifestyle. I think that's happening due to COVID, but it's also not helping that there were fewer investors over the last 3 to 4 years to be able to soak up some of the new rental demand that is coming in. And I'd make one other point. The reason that investors aren't investing is because rental returns are so low. And in fact, many investors are underwater. We've shown that again and again in our analysis. So it is a perfectly rational, logical thing for investors to walk away rather than buy more property in the wrong area of the wrong type. And that's especially true of high-rise apartments close into the centres of town. Houses, on the other hand, further out are a different kettle of fish. A special analysis of movement data released by Roy Morgan in Australia's capital cities CBDs since the COVID-19 pandemic began shows movements in the CBDs of Brisbane, Sydney and Perth all plunging over the last week as all three were placed into lockdown to deal with the latest outbreak in each city. The average 7-day movement level in the Sydney CBD last week was at its lowest since the pandemic began more than a year ago at only 11% of pre-COVID averages. This is a drop of 48% points since movement levels reached a 2021 high of 59% of pre-pandemic averages in the Easter holidays in early April. There were also record low movement levels last week in both the Brisbane CBD at only 23% of pre-pandemic averages and Perth CBD at only 25%. The movement levels in Australia's third and fourth largest cities dropped rapidly after the respective premiers announced snap lockdowns just over a week ago. The average movement levels in the Melbourne CBD has increased by 10% to 22% of pre-pandemic averages since the recent lockdown of the city, with mandatory mask wearing in offices and factories only ending this week on Friday, July the 9th. Despite this, increased movement levels in the Melbourne CBD remain slightly below the average in both Brisbane and Perth. Unsurprisingly, movement levels are highest in the only two state capital cities to avoid recent lockdowns, at 45% of pre-pandemic levels in the Adelaide CBD and 40% in the Hobart CBD last week. South Australians can take pride that their city has been the closest to normal of all capital cities for over 5 months now, with average movement levels not dropping below the 40% of pre-pandemic averages this year. But of course, the implications of this are profound, given the fact that economic activity reflects this same trend. So expect more retail businesses to go out of business and expect more difficulty in other sectors of the economy. We are definitely seeing a reversal of momentum. And if that reversal continues, expect more damage ahead. Now, overnight, the markets eased lower. At the close in New York, the Dow Jones Industrial Average lost 0.75%, while the S&P 500 lost 0.86%, and the Nasdaq Composite Index lost 0.72%. And of course, the markets here today also went backwards. Longer-term Treasury yields also slipped in the US. The S&P 500 Volatility Index also jumped 17% to 19. Fears over slowing growth were captured in the bond market, with the 10-year US bond yield at its lowest level since February. But some on Wall Street are not buying the peak growth jitters and argues that there is a runway for the recovery, paving the way for more gains in stocks. We don't think the markets are worried about economics and earnings growth slowing from these robust levels, at least at this point, said Wells Fargo. We favour economically sensitive sectors like energy, industrials, materials, and financials. Beyond the boost from fears over slowing growth, a decline in the supply of bond issued by the Treasury is also playing a role in boosting bond prices, sending yields lower. The US Treasury holds $733 billion in cash as at July the 6th, and is way behind in making progress towards bringing their cash balances down to the $450 billion target for the 31st of July, prescribed by the debt ceiling legislation. These paydowns will help the process along, but we still expect further cuts. The spike in COVID-19 cases, as the Delta variant continues to spread, has also put the dampener on global growth and threatens the summer of travel, particularly in Europe. And the labour market, meanwhile, continues to suggest a longer road to recovery, as initial jobless claims unexpectedly rose by 2,000 to 371,000 last week. In fact, technical factors are pulling the US 10-year Treasury yield lower, according to Moody's. They include the dearth of Treasury issuance and short coverings, and more fundamental factors pushing rates lower are the fading reflation trade and peak US growth. On the technical factors, the Treasury has drawn down its general account at the Federal Reserve faster than expected. The Treasury's general account at the Fed has fallen by more than $1 trillion since mid-September. This has reduced the need for the Treasury to issue additional Treasury notes and bonds to finance past rounds of fiscal support. Less Treasury supply, all else being equal, pushes Treasury prices higher and yields lower. Its account remains double that pre-pandemic, so it still has some cash it can tap into, and this week there was also little Treasury issuance, and what is scheduled to be issued is mostly bills. This dearth of bill supply is also putting downward pressure on rates this week. And there also appears to be another wave of short coverings as traders ditch losing positions. Another likely weight on long-term rates is the perception that US economic growth this cycle already may have peaked, though that doesn't mean the economy won't do well through the rest of this year and next. Despite a possible peak, growth through the rest of this year will be stout compared with that seen pre-pandemic, they say. There is a scarcity of US economic data this week, so there isn't a catalyst that could alter the bond market's view of peak growth. And the bond market has also likely got ahead of itself on the reflation trade, since a hot US economy doesn't mean runaway inflation is guaranteed. Also, long-term rates are down across many parts of the globe. This may signal renewed angst that the pandemic will re-intensify again as the Delta variant gains traction and vaccinations in much of the world are going slowly. The Delta variant of COVID-19 is now thought to be the dominant strain of the virus in the US, and more rural areas have sparser vaccine coverage and have seen a steeper rise in COVID-19 cases. So Moody's forecast has the 10-year US Treasury yield ending this year at around 1.9%, but risks, they say, are now clearly weighted on the downside. And one other factor to bear in mind is what's called the foreclosure cliff. That is essentially another challenge to the optimism for a quick economic recovery, because we're referring to the fast approaching foreclosure cliff. The federal government has provided substantial financial support to US households since the start of the pandemic. It's put moratoriums on foreclosures on homes with government-backed mortgage loans and on rental evictions, and it provided forbearance on government-backed mortgages and student loan payments. Moratoriums and forbearance has been extended several times as the pandemic dragged on, but policymakers now appear ready to allow them to expire. The foreclosure and rental eviction moratoriums are currently set to end at the end of July, and the forbearance on mortgage and student loans is set to end in September. This will be a meaningful adjustment for millions of households, particularly where forbearance rates are higher, such as the broad New York City region, which the pandemic arguably hit harder than anywhere else in the country, and the southern US, where borrowers' credit scores are typically lower than in the rest of the country. Now, fortunately, the foreclosure cliff has been decidedly smaller in recent months due to the fading pandemic, improving job markets, and substantial government support, including several rounds of stimulus checks and enhanced unemployment insurance benefits. But according to the Mortgage Bankers Association, close to 2 million homeowners are currently receiving mortgage forbearance. That's equal to about 4% of households with the first mortgage. Approximately 2% of Fannie Mae and Freddie Mac loans and over 5% of FHA, Veteran Administration, and USDA loans are receiving help. Moody's estimates that as at last month, there were 5.6 million delinquent renters, equal to 13% of all renters, who were $23.9 billion in arrears. So standing back, what you can see is that there are a number of shadows on the horizon, which explains some of the recent reversals in the market. Now, these are quite substantive. And as I've said previously, I think we're going to continue to see rocky roads ahead. In fact, the inflation story is weakening. The virus is still there and mutating. And of course, central banks, well, they may be trying to do a little less, but they may have to do a little more, which essentially just increases the debt burden some more. So once again, we seem to be backed into this corner without an effective escape route. How many times have I said that over the last few months? Way too many, I fear, but it's still largely true. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.